Ladies and gentlemen, I want to first and foremost thank you for joining me today so I can share with you a powerful financial concept that's going to help you to build a secure financial future. With that being said, let's go and get started. The American dream is alive and well, but it's grounded in new reality. And one of those realities is that we love our family, and family is the most important things in people's life. And being a parent or parents, what you're constantly thinking about is how to help your kids, your children to get the best education and provide the best for them so they can achieve their dreams. But the threat of dying too soon can bankrupt a family and will turn all your dreams into nightmares. Who's going to fund that little Johnny's education if you're no longer there? Who's going to provide your surviving spouse? Who's going to pay for their mortgages if you're no longer there? So properly protecting your family with life insurance should be on everyone's most important financial agenda. Although most people thinking about living feel thinking about dying, but planning for dying too soon is absolutely critical. Remember, people don't plan to fail, but fail to plan. What makes things worse is that Americans are not insuring themselves for the risk of modern living. Matter of fact, most people are way underinsured. If you look at statistics today, 70 million people are well underinsured, and 100 million people are not even covered by any kind of life insurance. And one of the top reasons for that is because affordability. Another dilemma that I want to share with you is the fact that people are living longer and longer today. You think that living longer is a great thing, but living longer and without money could be a disaster. For men today, the average life expectancy is about 83 years old, and for women, it's about 86 years old. It's sure great to live longer and longer, but it's absolutely not cool to living longer but without money. You're going to run out of money. And not only to mention the fact that 60% of Americans today have $10,000 or less saved for the retirement. The next threat is getting sick, getting ill. You see, half of all residential real estate foreclosures are due to medical debt. 2 out of 4 households that file bankruptcy were also due to medical debt. Right? The unemployment rate is double for people with medical disability. With a combination of people living longer and longer, running out of money, getting sick, 1 out of 2 adults going to have at least one chronic illness. The question is that how are you going to fund this kind of retirement and also illnesses when you do get sick? Is it even realistic to pass all this responsibility to your children and say that, well, forget about it, and maybe my children, and hope that your children one day is going to take good care of you? Well, that's a good thinking, but may not be a reality. Life happens every day in every community, in every family. Life events happen. Some expected and some are not. With such a financial storm brewing at the horizon, the threats of dying too soon, not getting enough coverage, living too long, getting sick, we definitely, absolutely need a more comprehensive solution to help the middle class American. We're talking about a threat that can literally turn your dreams into nightmares. Today, we have the solution. And ladies and gentlemen, let me introduce Living Life, our proprietary indexed universal life. One of the most important threats that Living Life addresses is dying too soon. More than ever, you need protection from the start. Financial debt and responsibility starts earlier than ever with student debt and only grows over time as we age. The death benefit of life insurance policy provides an immediate reservoir of funds that can be used to help you to keep your loved one's lifestyle stable while they're going through one of the most difficult times in their lives. Losing someone is bad enough. They do not need to have any additional financial stress weighing on them. And life insurance can fill in that gap. But reality sets in. A lot of folks out there can't afford what they want, what they need. Well, what happens if you can't afford what you need tomorrow? There's a gap in between. Let's take a look at a typical American family or American individual. As your life grows, your obligation also grows. As you just get out of school, graduated, you have student loans. As a matter of fact, the average student loan balance for a 4-year college graduate today is $37,000. So as soon as you got out of school, you have obligation and you need coverages right away. And later on, you get married, you own a car, You have a car mortgage, you got student loans also you got to be paying off for. You don't want to leave the burden to your spouse. You need more coverages now. And as you grow and grow, and assuming that you guys love each other so much and decide to get married, and chances are you might going to have a kid, you might have own a house and own a mortgage, and that also increase your liabilities. And finally, you don't settle for one kid, you go for multiple children, right? And you're going to upgrade your house, right? And you're going to upgrade your cars, right? All those things is absolutely a function of increasing liability and debt. What can you do if you can't afford the proper amount of coverage today due to affordability? Let me introduce you to our proprietary Gap Protector Rider. It allows you to purchase life insurance at your age right now, not at the age and health later on. It saves you the cost of waiting, locks in future protection today's health, which is absolutely critical. It is designed for those who need additional coverage, just like the typical middle-class family I just shared with you earlier, but need to work up to afford it. The amount of life insurance coverage and its premium can be increased annually by a pre-selected amount. You do not have to qualify again later on, regardless of health issues, and available only at the time of issue. So let's take a look at one of the most important feature of this GPR. Well, there are two things that can prevent you from getting additional coverages down the road. Number one is the fact that you're getting older. Number two is your health might not be the same down the road. But with GPR coverage, your premium is locked in at today's health, regardless of future health issues. And this is absolutely important. You see, if you're applying for a coverage today at age 30 years old, your health might be good, then your premium for all future GPR increase is set at the current rate, and your premium is locked in. And that's absolutely critical. Well, the benefit is that GPR saves you the cost of waiting. Let's take a look at an example. This is someone that does not have the GPR. At age 30 years old, he can only afford $250,000 because he can't afford more than that. So he has to wait until he can afford it. And this is assuming that each and every year he applied for an additional 15% more in coverage from the previous year. 15% more. And due to the increase in coverages, that 15%, he has to pay additional for that, obviously. And not only that, he has to worry about whether or not his health will stay the same. And assuming the health stays exactly the same, each and every year when the increase happens, the increase in premium is based on the age that he applies. So as you're getting older, every time, even though it increased by 15%, the rate of increase is higher every year. Due to this, the total premium he will pay is $182,094 throughout the next 20 years to obtain eventually $1 million coverage at age 50. However, with a client using GPR, this is what's going to happen. He can only afford $250,000 just like the previous person. But now with GPR, number one, the increase in premium due to the increase in face amount or death benefit is based on the issued age, which is 30 years old, regardless what his current age is. This is critical to understand. And second of all, regardless what his health condition is down the road, this is pretty much guaranteed issued once the policy is approved at the beginning stage at age 30 years old. So let's say when he's 40 years old, 45 years old, his health condition might not be as good as 30, but doesn't matter because he locks in the health condition at issued age as well. Using this example, his total premium using the GPR would only be $113,647. Comparing to the previous example, it's a whopping saving of $68,000. What can an average middle-class American do with $68,000 in saving? Paying off your credit card debt? Paying off your student loan? Or paying off your mortgage sooner rather than later? There's a lot of things you can do with a saving of $68,000. And that is the power of our Gap Protector Rider. I'd like to talk about the next biggest threat in our financial future, and that's the possibility of getting ill. Everyone could live longer, but some are living longer and ill. Half men and one-third women will develop cancer in their lifetime. Strokes are the leading cause of disability in the United States. Someone has stroke every 40 seconds. 41% Americans struggle to pay medical bills and have outstanding medical debt. You might think health insurance might be the problem solver right here. Well, considering how astronomical some of the medical procedures are that are not covered by your insurance company, and also consider how high most people have to pay out of their deductible before any insurance will eventually kick in. And that's a major problem. Not only about the medical bills, but when you get sick and when you get ill, ladies and gentlemen, you absolutely will, most likely will lose your ability to generate the same amount of income like before. The average length of disability is about 6 years. Ask yourself a question. If you stop working because you got ill, how can you continue to survive? As a matter of fact, 65% of working Americans reported they could not cover normal living expenses even for one single year if the employment income was lost. Not even 1 year. Living longer could be good, but it could cost a lot more. Living longer could also mean that there's medical bills, there's health insurance premiums. And today, a semi-private room in a nursing home costs $74,000 annually. 60% of people with cancer are 65 years or older, ladies and gentlemen. How are you going to pay for all those expenses, living expenses, and uncovered medical expenses, and huge, gigantic, sky-high deductible on your health insurance? The financial devastation that could occur from a long-term illness or injury can derail future plans, like sending your children to college, dancing at their wedding, starting your own business, and retiring. In addition to providing the death benefit, living life also has benefits that can be used in the case of qualifying terminal, chronic, critical illness, or critical injury. They are called accelerated benefits rider. Accelerated benefits rider are optional riders that can be added to a life insurance policy, and that gives the policyholder access to the death benefit early with a qualifying illness or injury during their lifetime. There is no additional premium for this rider because the policyholder is accelerating their own death benefit on a discounted basis, and the benefits can be generally used for anything. And that is tremendous. And are you ready for the last threat? The last threat is kind of ironic because we talk about people living longer and longer. But people living longer and longer without money, it's a big threat. 1 out of 4 65-year-olds is going to live past age 90 years old. The average American people is going to spend about 20 years doing retirement. How are you going to fund that retirement? And how long is your retirement portfolio going to last you? Well, before we talk about how you're going to fund your retirement, let's talk about how you're going to accumulate enough assets to pay for that retirement, shall we? It's not that easy. Market fluctuation, uncertainties. You see, statistics show us that people lost upwards of $20,000 in retirement account in the market in 2008. And that's 2008. What about the future? What about during retirement when you start taking money out? What if the market crash? So the combination of living too long and the uncertainty of the market creates a huge, huge problem. So let's talk about how you can be able to create that wealth and accumulate wealth before retirement. Because that's very essential to talk about. And here I'm excited to share with you and introduce you our Living Life Index Universal Life concept of accumulating wealth. The way it works is allow you to tap into the upside potential of the market, and then also at the same time give you the downside protection. Literally giving the best of both worlds, because what people want is make money, outpace inflation and have the best rate of return, but people don't like of losing money and having the risk of investing. And this is exactly the perfect concept created to resolve that need. So upside potential and downside protection, that is what we're talking about. But exactly how does it work? Well, it works like this. If we use the S&P 500 for an example, and we look at 2007 to 2008, S&P lost about 8.81%. So if you were invested in the market or the 401k and the stocks and tied to the index, you would have lost about 8.8%. But inside the indexed concept within our Index Universal Life, you don't lose anything. The crediting strategy basically protects the downside. So whenever you see a red, whenever you see a negative in the market in that year, you don't get the negative. You get zero. That means that you didn't lose anything, or you didn't gain anything, but you didn't lose anything. In 2008 to 2009, the S&P 500 lost about 36%. And that's tremendous, right? But then in our index strategy within the Living Life IUL, you get a credit of zero. So whenever the market goes down, you lose nothing. But what about when the market goes up, such as 2009, 2010, 2011? When the market goes up, your account will also go up accordingly, but up to a cap specified by that year. So in 2009, 2010, the cap was 14, so you earned 14%. In 2010 to 2011, the cap was 13.5, so you earn up to 13.5. So whatever the cap is, you earn up to that. Now, for an example, in 2014 to 2015, the S&P 500 has an increase of 12.8, but the cap was 13%, and guess what? You earn all of the 12.85% because it's still under the cap. That's exactly how it works, and this is the power of upside potential and downside protection. Well, now you've learned a great way to accumulate your asset in the long run. And now make sure we pick the right tax strategy, because at the end of the day, it's not just about how much you accumulate for retirement. You also need to factor in taxes. Very, very important. There are generally 4 tax strategies. The first one is called after tax, which means you save, invest with your after-tax dollars, so you pay tax one time, and every time there's a gain, whether you touch the money or not, there's going to be taxation each and every time. So you end up paying multiple taxes on that single saving. Not very good. The second one is called tax deferred, where you invest with your after-tax dollars and let it grow tax deferredly, but by the time you touch it at the end, you're going to pay one more time of taxation. So there are 2 taxes in general you have to pay for that saving. Better than the first one, but we believe the third and the fourth one are much better, because the pre-tax way, you only pay tax at the very end. You don't pay taxes up front because it's tax deductible, such as your 401k and your traditional IRA. And the last tax strategy is called tax-free. The difference is that you don't pay taxes later at the end, but you pay taxes right now, such as your Roth IRA and permanent life insurance cash value. So the question for you is that between strategy number 3 and 4, because we know they're the best, which one should you pick, pre-tax or tax-free? Question for you is that, do you want to pay taxes on the seed or on the harvest? Well, paying taxes on the seed is like paying taxes right now. You know, when it's small, when it's just a little seed, but that seed eventually is going to become a tree and become a lot of harvesting, maybe apples and oranges, and then you can decide to pay later if you don't pay right now. You got to pay taxes one way or the other. The question is that, do you want to pay now or do you want to pay later? Do you want to pay something when it's small, or you want to pay it when it's big? Well, to answer that question fairly and most intelligently, you have to ask yourself the following question. And that question is, where do you think tax rate is going to go? Well, if you think that tax rates are going up in the future, you may want to save tax-free, because then you pay the taxes now when it's low and never have to worry about paying taxes down the road when it goes high. On the other hand, if you think tax rates are going down in the future, you may want to save pre-tax so that you can take the tax savings right now and then pay it later down the road in the future. Well, with the current national debt closing to $20 trillion and counting, in my opinion, the chance for tax to go lower down the road is just not that good. So how does a life insurance policy can provide potential tax-free income? Well, it works like that. Each premium goes in, pay for the life insurance coverage, your cost of insurance, and after that, the remaining is going to go into your cash value. And by the time that you need the cash, you take it out in a policy loan. All right? And that is exactly what provides the tax-free retirement income according to Internal Revenue Codes. And lastly, one of the biggest questions that all retirees are going to ask them is that, well, now I follow your strategy. Now I use the most tax efficient way to save my retirement asset, and now I'm ready to take the money out. How long will it last me? How long will it last me? What if the market crash? What if I live to 110 years old? Will this pot of money that I've been working so hard in my past, that I saved up all these years, would it last me for however long I'm going to live? And does it take into account of any future market conditions? I'm very excited to introduce our lifetime income benefit rider, a potential income for life guaranteed. It is automatically added to eligible policies at no additional charge to add this rider, although there is a cost to exercise the rider. And at time of exercise, you have two payout options, either level or increasing. The lifetime income benefit rider can give you the guaranteed tax-free stream of retirement income that you can't outlive, as long as you met the following conditions. You gotta be at least 60 to 85 years old. You gotta have deposit for at least 10 years. You have to have no outstanding loans, plus other conditions. And once it's met, you'll be guaranteed to receive this income stream. How powerful is that? You never have to worry about a market condition, and you never have to worry about outlived by your money. In addition to retirement purposes, the cash value inside Living Life IUL policy can be used for literally whatever purposes you want to. College savings, buying a home, emergency fund. Literally, it is an account, it is a balance that can be used for multiple purposes. Ladies and gentlemen, I've just presented to you the life insurance solution for you. Remember what I talked about? There are 4 threats in our life. People dying too soon, you need life insurance coverage for your family, for your loved one. People getting sick, whether it's terminal, chronic, critical ill, critical injury, you need access to income stream, income sources, which is our accelerated living benefits. What if you don't have enough coverages? What if you can only afford a small coverage, but you need much, much more? There comes our GPR, our proprietary gap protector rider. And what if you live too long? What if you live a long, long time and healthy? And ladies and gentlemen, and that is where our cash value comes into place, because it allows you to have a potential tax-free retirement income for life. And all this is in one combined solution called Living Life Index Universal Life Policy. See, you live your life, you're busy living your life, and you're dreaming, you're planning. Ladies and gentlemen, one of those threads can literally derail you from reaching your goals. But ladies and gentlemen, today we're introducing you Living Life. It is here for you. It is right there to protect you. It is right there to help you to plan for your retirement and achieve tax-free retirement all in one. With that being said, Mr. Client, would you like to see the actual illustration so I can run some numbers so you can see exactly how this policy can work for you and your family? Thank you.